This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perney. Today on the download, we're looking at markets trending down a little bit. Unfortunately, the Fed has indicated that they will be moving towards a rate hike in a little bit, which is causing things to settle down a touch. We're seeing the Dow Jones Industrial Average looking down about a 1.4%, at least of their recording of this intro on Monday, the 10th. The S&P 500, NASDAQ, the Global Dow, gold, and oil all are trending down this morning. However, it is rather anticipatory as the markets have been on an extended bull run, so the correction a bit is not to be unexpected. However, markets such as housing and cryptocurrency are all seeing continued rises. However, cryptocurrency seeing a little bit of a leveling off. The housing market, with low inventory and an increased amount of earnings and wages from the majority of the U.S. workforce, is continuing to see a steady rise. However, some of the other markets are still being tempered by the extremely virulent Omicron strain of the COVID-19 virus. We are also seeing the Supreme Court of the United States debating a case on mandatory COVID-19 vaccination, which is expected to have direct implications to markets if this does or does not pass. We could see a shift going either way, with an upswing or a potential downswing going in either direction, depending on how people actually react to it. So it's definitely something to keep an eye out on. Used car prices are also continuing to stay high, with the average price of a used car in the United States up almost 40% at $28,000 from this time last year. So again, consumer goods with inflations, looking at the consumer price index, are all continuing to rise. However, we are seeing a significant rise in earnings from the U.S. workers. So some of those things are being tempered by those types of markets. We're also seeing a interesting increase in the popularity of electric vehicles, with several major manufacturers coming onto the scene with produced vehicles in the new year, including Ford and General Motors, both introducing new electric vehicles to the market, and some interesting IPOs and other companies that are coming into the market, such as Rivian with their electric pickup truck as well. Now, the continued down slump of the markets is something that, again, is expected to continue, at least in the short term. Again, the Dow Jones Industrial Average being down about 1.25% today on the 10th as of recording is a continuing slump from the 300 points that it lost last week. Goldman Sachs is also raising forecasts with regard to the Fed rate increase that is expected to come. So it's not just the market anticipation, it's also analysts looking at it, which also have driving forces in the markets. Now, it's something to certainly keep in mind, but it is not generally seen as something that the analysts are looking at as far as a panic. Now, in other markets, we are also seeing some significantly far harder changes. Most of the Asian stock markets, with inclusion of the Nikkei index in Japan, are starting off with a rather mixed bag of trading. The Nikkei trading down, however, it is seen as very localized, with most of the trading occurring in the tech sector. Definitely some things to keep up and watch out for. So please do make sure you tune in for the next iteration of the Alternative Investing Advantage podcast. My name is Alex, and this has been The Download. Today on the What is a 1031 exchange? IRS Code 1031 allows for the exchange of assets without having to pay any income tax due to the identification and purchase of new assets within that same class. So if you were to, let's say, have a piece of property that you purchased for $100,000 and the sale price of that property being $200,000, you would have a $100,000 gain to pay taxes on. Now, under Section Code 1031, you are allowed to identify and purchase new properties within 30 days of the sale of that property. You can reinvest all of your earnings into the new assets without having to pay tax on them. However, what you are doing with this particular subsection of the Internal Revenue Code is deferring your taxation down the road. People who have made this popular are people like former President Donald Trump and a lot of real estate investors, a very useful portion of the tax code to take advantage of. This has been The Download. Welcome, and thank you for attending another edition of the Alternative Investing Advantage podcast. My name is Alex Perney, and today I'm very pleased to welcome to our podcast my guest, Dyches Boddiford. Dyches Boddiford is a Georgia native who has a very long career in real estate investing and had some interesting beginnings to it, not necessarily directly related to real estate, but definitely a fascinating interview for sure, a big promotion of real estate education and the like. So Dyches, thank you very much for being on with us today.
Well, thank you for inviting me, Alex.
Yeah, it's my pleasure. So I always like to kind of start out these with letting the guests kind of give an introduction to themselves. I know you kind of have an interesting background with regard to your education, probably a little bit different than most of the people I've had on here. I've had attorneys, I've had CPAs. But rarely have I had people with degrees in physics and computer science on here that end up being real estate investors. So tell us a little bit about, kind of where you got your start in all this and how you kind of evolved into what you're doing today.
Sure. I went to Georgia Tech, and undergraduate work was done in physics, and decided I didn't want to stay in a lab all the time. And so I got a master's degree in computer science. Neither of which I've really used over the years. My first job out of college was as an electrical engineer. I did that for several years. And around 1980, after I'd been out of college for about 9 years, 8 or 9 years, I started looking around for what did I need to do to build an estate for myself, something to fall back on and something to retire on. And I kept looking at different areas, starting my own business, doing real estate, doing stocks and bonds. And I kept coming back to real estate as an area that was wide open. I could build not only with money that I had already earned, but with sweat equity. And a lot of the other opportunities didn't allow the sweat equity component. So I started buying real estate in 1980. And single family houses were my primary concern, and renting them out. And I continued that for several years. And then I bought a couple of discount mortgages. As one thing led to another, I went through several different types of real estate investment, including apartment buildings, which I did not do that well in and don't care for even today. One of the problems was I didn't realize that the character of the tenant is different in a single family house than it is in an apartment building. Whereas in the single family house, a person might want to keep his family in a good school district and might hold on to that rental for years and years. In the apartment building side, it was more a user, someone that's going to use the apartment, use the benefits that they have in a complex, but never have really an ownership interest, and therefore didn't keep up the property as if they were an owner, which was done in single family houses. So I quickly decided single family houses were the way to go. And I started getting into some lending. I built some properties, did a couple of subdivisions, built out the subdivisions, and just one thing and another. It's over quite a few years now, 40-something years. I've enjoyed real estate investing.
So
is that brief enough, Alex?
That'll do just fine, Dykes. It's really kind of interesting from there, though, that you bring up the kind of the reasoning why you chose to go one route versus another with regard to the apartment complexes, and that it was the nature of the tenant, not necessarily maybe or the nature of the user. And when I say user, I'm kind of referring to, either the renter in the apartment side, or, whatever kind of deal you're working out with the people that are renting a single family home. Most people that we have on, talk about very rigid cash flow metrics. So like, okay, well, this made me X dollars on my return, and then this is the other way of looking at it. And there's a few different people. One namely jumps out to me that's kind of had a similar view to you is Pete Fortunato, which I know you know Pete very well, in that both of y'all have been doing this for a very long time, and it's kind of interesting that that same thread would come up of the interaction that you have with people being kind of a driving force of what changed your focus from one type of real estate to another. And we've been very centric on the apartment investor with this podcast so far, not by any real measure of me trying to do that, but there's a lot of people out there trying to raise money to buy apartments, and I always like to bring this back to what a lot of our clients have gotten their start in, which is single family homes. So now. So,
Alex, I see apartments as a business more than a rental type of investment. Because of the oversight that's needed, you almost have to have a manager, whether you manage it yourself or you have an on-site manager for the apartment buildings. Where single family houses, you might call yourself a manager, but really the interface that you have with the tenants in single family houses is when you put them into the house, and if you have a repair that needs to be done. And otherwise, not much oversight is required at all. So I think there are different types of investments. I think the single family houses are a true investment, whereas the apartment buildings are more like a business. Mobile home park would be another type of investment that's a business, as opposed to just being a passive investment.
Sure. Now, and there's 2 points that I'd like to kind of focus on in there, mobile homes, and then also the strategy that you've kind of used over the years with single family homes. But it's interesting that you would bring up the mobile home park specifically as a business. And I definitely I get that, it's an apartment. It's kind of like a chopped up apartment complex, instead of having the building going up, it's spread out over a larger area. The same kind of
Jack Miller used to say that a mobile home park was a horizontal apartment complex.
Well, that's interesting that I can share a quote that I never knew Jack Miller said with something that I came up with. So I got that going for me, which is nice. But that is interesting that would come up, and that it's been kind of identified is that. With that said, now would it be accurate to say that you've tried to get away from that business, that heavily managed style of investing for any type of real estate asset for the most part?
For the most part, as you get older and you get further into your real estate career and build up assets, you tend to, no matter what the return is, gravitate towards the easier ones to manage.
Sure.
The ones that are more hands-off than others.
Great. Now, obviously, you said mobile home parks kind of fall into that heavily managed style of asset class when it comes to real estate. But have you done, or do you continue to do anything with mobile homes on land, or do you try to find brick and mortar stick houses and things like that? Do you ever venture into that area of real estate investing?
Mobile homes are something I made a good bit of money in back in the late 80s and early 1990s. And I actually did a mobile home subdivision of homes on land. But the best investment has been the sticks and mortar houses, single family houses that I put people into. With the mobile homes, typically what I would do is, rather than rent, though I do still have some that I rent, I usually would fix up the houses and sell them on terms. And you'd have to stay on top of them to make sure that the people took care of the property. But it gave some very affordable housing to some people that really need it.
Absolutely. And that's interesting that, and I'd like to dig into that for a little bit. You said that you did a mobile home subdivision that was homes on land.
Correct.
That's something I've never really heard of someone on the development side doing. Maybe if we wouldn't mind maybe telling us how that kind of came about, because I think that would be really interesting for some people listening.
All right. Well, in the 1990s, we were heavily into doing mobile homes in other people's parks. And what we do, we'd buy homes that were foreclosed on, or otherwise we could buy at a very inexpensive price, fixed up the homes nicely, and let the park managers sell the homes on terms for us. And basically, we told the park managers that if you don't qualify the people for the community to live in the community, then don't even bother showing them the mobile home, because if you don't want them, we don't want them. And so we had actually a sales agent in the terms of the manager, qualifying the people, pulling the credit and so forth, and checking backgrounds. And then we would look over the information, and 99% of the time we'd take the people if the park manager thought they were good. And with a down payment, we then financed the remainder of what was owed over a 10-year term. And we did that very well, did very well in doing that for quite a few years, until the institutions started financing mobile homes at a very low interest rates. And they even had 3% down deals on mobile homes. And we didn't find that worked for us. It was too much risk. We had to have more down than that, and we didn't need the competition. So we started looking around for what to do next. And one of the things was mobile home subdivisions. And you couldn't do them in every county, only in counties that allowed it or didn't have zoning at all.
And this was counties in Georgia, correct?
Counties in Georgia and South Carolina, coastal
Okay.
South Carolina. So we did some couple of subdivisions in each place. And matter of fact, we sold the last lot in one of our South Carolina subdivisions just earlier this year.
Oh, great.
Yeah, and I've been holding it since the late 1990s, and had sold
awesome.
out the other lots. Yeah.
Awesome. Yeah, that's really interesting. I've never kind of really heard of people going the development route. There's been a lot of people down and in our area of Florida that have gotten significantly more interested in mobile homes recently, just because of the crazy prices that are going on with single family homes on the coastal counties. So Pinellas County, Hillsborough County, Manatee, Sarasota, all the ones that, border the water. Anything in those counties is getting just crazy expensive. But when you go a little bit inland over into Lakeland and Polk County, it gets to be a lot more viable to get into real estate by buying. If you want to buy something that has actual land and a home on it to rent, I mean, you can still get, some pretty good deals over there. And we've seen a big shift back over from the single family stuff into people being very interested in, and doing very well in the mobile home space. So with regard to that strategy, that's really interesting. Now, when it came to developing some of these mobile home parks, what were some of the issues that you might have run into? What kind of things were the common issues? You mentioned, you couldn't do them in all counties in Georgia and South Carolina, but what were some common thread issues that you saw? Obviously, it was a good enough investment and you did well enough to, have just kind of gotten out of one of them here recently, but what were some of the common thread issues that, that you saw that might be beneficial for someone that may be looking into possibly going down that? Yeah. So what are some common thread issues that you might have seen throughout your career and the part of your career that was based in doing mobile home developments that might be a benefit for people to know, that if they're looking to get into this realm of real estate investing would be good to know?
Well, one of the reasons you don't find books written on real estate development for mobile home communities or for single family houses, site built houses, is that every county, not just every state, but every county has its own rules about setbacks and wells and septics and so forth. So you've got to learn from someone in your county that's already doing it if you want to be efficient in getting it put together. Now, you can always do it by trial and error, but that's the most expensive and longest time element to get it done. But fortunately, we knew some people that had done it before. So we kind of used them as our consultants and what we needed to do. And they also knew some of the people at the county level. Someone that has done this kind of development before in that particular county, not the county next door, because the rules are going to be different, but in that county. And just spend a little bit of time with them, talking to them about what their challenges were and how they overcame those challenges. And if you can get them to consult with you as you are developing your particular tract of land, it can be very beneficial. And you might spend a few hundred, a few $1,000s consulting, and that can be a very cheap avenue for learning what to do to get the project finished.
Yeah, it's a lot cheaper than the trial and error method of just throwing things to the wall and seeing what sticks. Those lessons can be very expensive to learn, right?
That's right. That's right. That's always the case. That School of Hard Knocks is always the more expensive and more time-consuming way to learn something. Best way is to learn from somebody that's already done it.
Yeah, and that's really kind of a great thing to take away. And although I do sound a bit repetitive when I have guests on that echo that, I always like to parrot that one statement. It's about the relationships that you build in doing real estate specifically, or really anything in life that can help you the most. It's not necessarily, maybe a course you can take, while certainly education is fantastic. It's those relationships that can actually show you what does and doesn't work and can help you guide you from their experience, so you don't have to take that class and pay that money to learn it the hard way. So now transitioning back from the mobile homes back to your strategy with sticks and bricks, what has been kind of the common thread that you have used through your single family real estate investing career? Because it sounds like that is kind of what you've transitioned from the mobile home part of what you did to sticks and bricks. What has been kind of the common thread strategy that you've used from when you kind of made that your goal, or I should say the main focus of what you do on your investing side of your career, that has really helped you the most, that you think that would be good information for people to take away?
Well, having people around you, friends and associates that also are in the investing business is something that will spur you on to doing more. And that's what you've got to do in doing the investing, is to continue on. And when you run into problems, take care of the problems, and don't let those problems win over what you're doing. Because if you do, then you are not using your time to the fullest in building your asset portfolio in the area of the housing.
For sure, that's definitely great advice. What are some of the things specific to your area when it comes to maybe finding deals, or maybe that kind of work across the country? Because I don't know necessarily where you have focused on purchasing property. I guess that's probably the better question to start with. Where do you normally focus your efforts on finding properties to buy? Do you just focus mainly kind of on your small area? We had Bill Cook on the other day, and he door knocks just around the Walmart right next to his where his house was in Georgia. Do you have that same kind of philosophy of sticking very local, or do you kind of look to wherever the good deals are? Or tell me a little bit about where you like to focus your efforts.
Well, I focus these days mainly around the greater Atlanta area. And but there was a time when I would do anywhere in Georgia and pretty much anywhere in coastal South Carolina. When I say coastal, I'm talking about 2 or 3 counties inland to the water, not around Columbia or upper state. Didn't get into those areas. But the idea was that I could get good deals, could get them fixed and sell them and 1031 back into properties that are in my area, in the greater Atlanta area. And I try to stay 30 to 40 minutes as the maximum drive time to get to any one of the investments. That doesn't always go that way, but that's just a target.
Great. So that's obviously there's the convenience factor of something being close to you, but what were some of the issues that would crop up when you had stuff a little farther away? Obviously if you live in Atlanta, Atlanta's not really super near somewhere like Valdosta, and it's certainly not near, coastal Carolina per se. So what are some of the issues that would crop up that kind of made you transition away from doing that past just the convenience factor of being able to drive somewhere and put your hands on the property? What are some things that cropped up that were common issues with investing a little bit outside of your backyard?
Yeah, I had, even when I started investing outside of my backyard, I had the intent to eventually move that asset profit back into something in my area using the 1031 exchange. And I found what I expected to find, and that is uneven application of landlord-tenant laws. Different judges in different counties had different ways of dealing with it and giving people additional time beyond the law to stay in the property and I would be prevented from kicking them out if they didn't pay. So, it was things you would expect. You didn't have a vendors list for that remote area, remote from you, that is.
Sure.
So you didn't have somebody that you could just pick up the phone and call. You had to call around to some of the real estate agents or some of the other vendors to get a vendor's name for a particular thing that you needed to get done. So that was always an issue. In addition, as you pointed out, getting in the car and driving there if there's a problem that needs to be handled.
Yeah, that's certainly some people like to think that there's some huge issue, and sometimes things can be just that simple. I think people have a huge tendency to overcomplicate things, but the issues that are simply just caused by time and distance, can propagate into many other things. And if you just keep things simple, close, you can make your life a whole lot easier. You can find those deals. You might just have to look a little bit harder in your local area, but that little bit of extra work
One thing I tell people to do, and this is a little off of the topic we're on, but I tell people that at least once a year you should get a spreadsheet and list all your properties, and then list several columns of how easy is it to rent, how much maintenance is required, distance from you. You can think of a lot of subjective and objective questions to list several columns, and list the houses in the order of preference in those columns. And when you get through, no matter what your questions were, you'll find a few houses clustered at the bottom that are your problem properties, the ones that don't let you sleep well at night, the ones that require constant advertising because you have tenant turnover. Maybe maintenance is high on a particular property. And those are the properties you need to get rid of over the next year, either selling them with owner financing, selling them outright through an agent, or as an owner FSBO. But you need to get rid of those properties because those are taking a lot of your mental ability and a lot of your time and effort. And if you get the better properties, keep the better properties and get better properties instead of those, you'll do a whole lot better in building your portfolio and feel better about it as well.
Fantastic. That's, again, another fantastic, bit of information on just keeping it simple, and a simple way to keep things simple of just identifying once a year, find your bottom three, your bottom couple of properties, and just trying to move those out, and then take the capital you get from that and put it back into something that is going to fit better into your metric of successful investing. And before I kind of transition into my next question, you had brought up a couple of times, you had mentioned 1031. Now, obviously, the more seasoned investors that might be listening to this certainly probably know, but I want to make sure that this is accessible information to everyone. Now, when you say 1031, if you could give us maybe the 30,000 foot view of what exactly do you mean when you say 1031?
1031 is a code section in the IRS code, that the tax code, that talks about exchanging one property for another property. Instead of just meeting someone that has a house and you say, hey, I'll trade you my house for your house, the 1031 exchange gives you a delayed exchange ability where you can sell your property, You have 45 days to identify another property. It doesn't have to be in the same area, just other real estate. And you can identify up to 3 properties. And then within the 180 days from when you sold your relinquished property, you have to close on the replacement property, one of those 3 properties that you identified. If you do that, then all the money that came from the old property going into the new property is not taxed. Whatever your basis in the old property was moves over to the new property. And if you have a problem like financing that's over the basis of the property, which could create a significant tax issue, you've moved it down the road, and it will work itself out over a period of time. So if you don't want to pay any taxes, but yet you want to sell a property, 1031 exchange is certainly something to look at.
Great. Thank you very much for that. It's one of those things where I think, especially with what I do dealing in, self-directed IRAs and retirement plans and all sorts of exotic stuff, sometimes, we lose focus on explaining some of the basic things. And I always like to make sure that, terms that kind of get synonymous with real estate investing, are accessible. If someone's just getting started learning about this kind of stuff, they get some of that information, because it is, certainly a good thing to know. Because, if you're obviously listening to this podcast, you might be, I shouldn't doing this stuff through IRAs, but if you're doing this stuff in your personal name or with a corporation, being able to creatively defer taxation or eliminate taxation is going to be hugely beneficial, because it's not necessarily about how much you make, it's about how much you keep. And if if the government is coming in and taking all of your profits, well, if you may have made 20% on paper, but if they come in and take, 15% of your profits or more, depending on how long you may have held the property, then, that gets to be a significantly less good deal.
Right. And typically you don't need the 1031 exchange for deals that you're doing inside of your IRA. However, there are times when you might have been paying unrelated business income tax on a property. And if you sold it, you got the unrelated business income tax on the sale price as well. Whereas you do a 1031 to another property also in the same IRA, you can move that issue over, and gives you more time to pay off that loan and get away from having any UBIT.
Yeah, exactly. And what Dyches was referring to right there is that if you finance a property purchase within an IRA, there is taxation associated with that particular property. So there is a way to get out of that. Obviously, doing real estate investing within the IRA tax shelter is really attractive. But if you need to finance a property purchase, exposing the IRA to UBIT, or more specifically, unrelated debt finance income tax, which we've covered pretty extensively in our webinar series, is something that you definitely want to try to avoid. So unlike doing things in maybe a solo 401k where you are exempted from that tax, which is what I recommend to a lot of clients if they're looking to finance real estate purchases, is looking strongly about trying to qualify for a solo 401k. And I know you're a big proponent of those, and so is your daughter as well. Teaches some very fantastic information on solo 401ks. So if you're interested in learning more about that, we teach a lot on solo 401ks, and Dyches, your daughter actually teaches a class on that. Does she not?
Well, she has done a class in the past and a webinar, and she will probably do another one again. Pete and I do talk about the 401ks, and she talks about them in our annual class on investing in IRAs. So
Yeah,
the information is out there from Advanta as well as from us.
Absolutely. And that's what I kind of wanted to transition into, because that's what you focus a lot on now. I mean, you have your Assets 101, which is your, correct me if I'm wrong, it's an educational company, correct? You do a lot of, educational real estate education. Tell us a little bit about what made you want to get into the education side of things and what you're kind of teaching on, and then we'll end with what you might have going on. So yeah, you have Assets 101, which is your real estate education company that you do speaking events in and educate people on different real estate topics. Tell us a little bit about what made you want to get into being an educator. I know a lot of people have taught classes, but very few of them have kind of been as perennial as you have with teaching year over year and bringing great content to people. So what made you want to get into the education side of things?
Well, in 1991, I think it was, I was president of the local REIA group here in Atlanta. And I kept having people call me about how to do this, how to do that. And so I finally decided I'd do a one-day class just for the members on corporations, because a lot of people were wanting to set up corporations for flipper property and other tax advantages. So I did the 1-day class, and I got a lot of interest, asking me to teach on some other topics, but I just did it for the local audience. And I didn't do very many, maybe 3 or 4 classes over the period of 6 months or 8 months. And a national speaker heard about it and asked me to come talk about corporations, that then came to other classes that I did. And it was a natural adjunct to the investing, because I only teach on things that I've done or have a significant interest in, that I am going to do. So it was a practical information that people could use, investors could use. And I've just kind of over the years done a little bit more, and a little bit more, and a little bit more, until I'm at the point that I'm at now.
Fantastic. So where can people find you? And do you have any classes coming up that you'd like to promote while we got you on the call?
Oh, great. Thank you for asking. My website is assets101.com, ASSETS101, the digits 101.com. And you'll find classes are coming up there. The 2 classes I've got coming up are hard money lending. A lot of real estate investors, especially after they've worked in the real estate area for a few years, have money just sitting. And sometimes you can make good hard money loans while you're waiting for another deal to come along. So I've taught that class for 22 years now, I believe. So I'll be doing it virtually starting in February. I think it's February the 21st is when we start, when it goes for about 2.5 weeks. Then I've got another class on trust concepts, which covers the land trust and the personal property trust, coming up in April 19th, this next year. So that's also a virtual class. We're trying to do virtual classes just because of the pandemic, and a lot of people would like the fact that they don't have to spend money on air flights and hotel rooms.
Sure, absolutely. Well, Dyches, thank you very much for being on with us today. I really appreciate your time. I know you're a busy guy. Thanks for sticking with us through the few of the lovely technological issues that Zoom was having today. But again, everyone, if you want to get more information from Dyches, he's a fantastic speaker. I've heard him speak a few times. Assets 101. He just gave the information on where you can find him, and it's assets101.com. It's where you can find his website. Again, thank you very much for being on with us, Dyches.
Thank you, Alex.
And have a great day, and have a great holiday season as well.
You too.
Thank you. Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.